Today, I want to break down the difference between three major types of life insurance coverages: term, whole life, and index universal life insurance, also known as the IUL. Understanding the difference between these options can be critical in your decision making when you are ready to make the big decision on which type of policy suits for your financial future, as well as protecting your loved ones. So let's dive in. First, let's talk about term life insurance. Term life insurance is the simplest and most affordable type of insurance. It provides coverage for a specific period, usually 10, 20, and up to 30 years. If something happens to you during that term, your beneficiaries receive the death benefit. Think of term insurance like renting an apartment. You're paying the coverage for a set period, and when the lease or term ends, so does your coverage. There's no equity or cash value buildup. It's purely protection. And here's a tip. Term life insurance is great if you have specific financial obligations, like a mortgage, that you want to ensure you are covered in case something happens to you in that term. It's especially ideal if you're looking for substantial coverage for affordable rate. Now, let's dive into a second type of coverage, which is whole life. Unlike term life insurance, whole life covers you for your entire life as long as you are paying your premiums. One of the biggest benefits is that it builds cash value over time, which you can borrow against or even withdraw under certain conditions. Whole life insurance is like buying a home instead of renting. While upfront costs may be higher, you're building equity or cash value over time. This can be a financial asset that you can tap into later in your life. And here's a tip. Whole life insurance is a great choice if you're looking for lifelong coverage with the added benefit of cash value component that grows steadily over time. It's a way to ensure you leave something behind for your loved ones no matter when you pass. Now, the last but not least, let's dive into index universal life insurance, also known as IUL. IUL combines the lifelong coverage of a whole life insurance policy with a cash value component, but with a key advantage: the potential for upside gains while protecting your downside losses. The cash value in an IUL is tied to the performance of a stock market index. Imagine IUL as a safety net that lets you walk the tightrope of investing. You can participate in the market's growth, but if the market takes a downturn, your policy has built-in protection to protect you from losing money. This makes an IUL an attractive option for those who want the potential for growth without the risk of losing their cash value. And here's a tip. IUL is great if you're looking for flexible, long-term coverage that offers growth potential with protection against market volatility. It's like having the best of both worlds: security with the potential for growth. To wrap everything up, in simple words, term life is like renting. It's affordable and great for temporary coverage. Whole life is like buying a home. You're building equity over time with a lifelong protection. And IUL is the best of both worlds. It offers growth potential with downside protection, making it a smart choice for those looking to balance security and opportunity. And here's my last tip for you before you make that decision. Think about your current and future financial needs, your family situation, and your long-term goals when choosing a policy. Each type has its own advantages depending on what you're looking for. I hope this video gave you a better understanding to help you break down the difference between three major types of life insurance coverages. If you have any questions or need further guidance, reach out to me and let's book a free consultation. I'm here to help you make the best decision that will help you and your family. See you next time.